Good evening, everybody. A warm welcome to today's study circle meeting on credit ratings and introduction to international bond markets. We have with very eminent and expert speaker on the subject, Mr. Lakshmi Prasad. Now I request CA Babu, Chairman of Bangalore branch, to escort today's speaker to the dais and welcome him with the floral bouquet. Before I introduce to today's speaker, we have an important announcement. We have a special program. It's a public the program is open for public. It's a Union Budget Analysis program at Christ University on 11th of this month from 4 to 8 p.m. at Christ University, and members can make use of this opportunity. And this is open for public, and you can bring your clients and also as well as your colleagues in the office. It's my proud privilege to introduce Mr. Lakshmi Prasad. Lakshmi Prasad is a chartered accountant with 7 years of experience in the capital markets, corporate finance and assurance services, and he is having international experiences includes working out of financial districts of London, Amsterdam and Mumbai, and he is a passionate to finance training with a corporate in-house as well as a guest training experience. As well as he has having a corporate experience, he has worked for Moody's Group as a senior associate vice president, debt capital markets. During this, he was working responsible for setting up of training and heading of offshore debt capital markets team for a large European investment bank. He has also worked for Deutsche Bank and also UBS Group and GS Reddy and Associates as a senior associate assurance and valuation. He is also having wide training experiences and designed and conducted financial analysis and credit conversion course for new hires and latest at Moody's, and trained IIT and IIM graduate hires at laterals and corporation finance, bond markets in DCM divisions of Deutsche Bank, and conducted extensive training programs of new hires and laterals in mergers and acquisition division at UBS Swiss Bank, and trained the finance delivery for the product terms as a guest trainer at IT companies and ID Sign Technologies and Hard Technologies, Flying Star Information, etc. During his assurance service realization, he has conducted various statutory audit, revenue and tax audits of a public sector banks, corporates and firms, project valuation and credit appraisal assignments involving preparation of relevant reports, financial projections, preparation of project valuation reports for various banks and market-based financing, and negotiating with the bankers on the behalf of clients for various types of bank finance, trade finance, factoring, debtors funding, export finance, working capital finance for getting the best deal of that. With this brief introduction, I present before you Lakshmi Prasad. Over to you.
Good evening, friends. I thank the Bangalore branch for giving me this opportunity to present myself before esteemed members like you. I thank especially the chairman, sir, for readily accepting my request for a session, and I thank the members for giving an elaborate introduction to me. Probably I'm not worthy of all of it, but I am enjoying it. The idea of today's session is to introduce someone who is not from a capital markets or a debt markets background to the basics of credit ratings and what happens. Why do people? Why do companies need to get their credit rated? And what is the importance of credit ratings? And basically at a very basic level understanding of how the bond markets work, international bond markets work. Before going ahead, do we have anyone from credit rating agencies here? Has anyone worked in a credit rating agency, or has anyone worked in a bank or dealt with a bank? Yeah, okay, great. At a very fundamental level, if an individual goes to a bank for a loan, the bank obviously does its own assessment as to the creditworthiness of that individual. It sees how much loan can be sanctioned to that person basing on the expected income and basing on the past track record of that individual, and then decides, okay, Mr. X can be given, say, 5 lakhs rupees of loan because he has about 50,000 income per month. So this credit assessment process happens in-house in the case of a commercial bank. But when we are talking about credit markets or the bond markets where the debt is traded on a day-to-day basis, the way we have a share market, there is also a bond market. In India, the bond market is in a very nascent stage, it's still not developed. But the international bond markets are very huge. It's probably twice or thrice the size of the stock markets. So in which case, when companies come up and issue debt in the form of bonds, these bonds are traded on a day-to-day basis. The investors in these securities need some benchmark or a parameter to measure the creditworthiness of these companies. For example, if say Reliance Industries approaches State Bank of India for a loan, a term loan, State Bank is the only investor there. State Bank is the only entity which is putting its own money in Reliance, and it expects that money to be repaid after say 5 years or 7 years or 10 years. Therefore, this lender gets access, requests access to Reliance's financial statements. They make their own analysis, and they, based upon their assessment, they either lend to the company or they don't lend to the company. But if I'm an investor in a bond market, I can buy and sell bonds in the international bond market. I won't be able to go to the issuer and ask for its financial statements or the information which is not public, and perform my own analysis before I invest. Therefore, I need someone who is an expert in this field to generally assess the creditworthiness of that particular company and give me a report. It's more or less similar to the broker reports that we see for equity stocks. It can be you get Sharekhan or some other car be performing research, broker research, and providing you with these reports, looking at which we invest in stock market. Similarly, credit rating agencies help us and with the documentation which we can go through before investing in the stock market, the bond markets. So I haven't prepared too many slides, even though I was informed about the event a month back. I really couldn't get my hands on it, but I try to make it as interactive as possible. So if you have any question, you just stop me right in the middle so that we can discuss it then and there itself rather than waiting till the end of the presentation. So what kind of entities need to be rated? For example, if I'm an individual, I don't need a credit rating for me, because if I go to the bank does its own analysis and either grants me a loan or it doesn't grant me a loan. Whereas people or entities which raise funds in the markets, especially in the bond markets, or especially in the, it can be a commercial paper market. In India, commercial papers are quite liquid. So they need to get themselves rated. So they approach these ratings agencies, they invite them, and they help them with all the information that they need to perform the analysis, and the credit ratings agencies does this analysis and gives them a particular rating. It can be a score, or it can be a number, or an alphabet, and they publish these reports. They publish these ratings in the form of a report with detailed explanation. So in that case, if I want to invest in a bond of say Reliance, I can just purchase one of these ratings reports, go through it, understand the risks, understand the return, the kind of returns that this company can give, or understand the liquidity concerns of that company, and then make a wise decision. Therefore, corporations looking to raise money in the bond markets need to get rated. In many countries, it's mandatory. In some countries, it's not mandatory, but they still do it because it's a good practice and it improves their chances of raising funds in the market. Then, apart from corporations, governments also do raise money. For example, Indian government issues bonds the same way the US government issues treasury bonds. Every other government issues some kinds of bonds, and investors it can be common people, retailers, or institutions. They invest in these bonds. We call them in India gilt securities, I believe, because they are supposed to have zero risk. But then, not every government has zero risk. For example, a country which is stronger, like United States or United Kingdom, is not comparable to a weaker country like in Afghanistan or in Iraq. So we can't call every government security as zero risk security. Each government has different levels of debt, and each government has different levels of risk involved in it. Therefore, governments, when they go out in the international bond markets, even they need to get themselves rated by these credit rating agencies, so that we understand. For example, if say Romania, which is an Eastern European country, it comes up with a bond issue in the Eurobond market, and I have money, I want to invest. I need to know what kind of country this is. I need to know, first of all, where in the world map does Romania figure out, and what are its political concerns, what is its economic situation at this moment, and does it have any track record? If we are within India, it's easy for us to trust Indian government, because no matter which party forms the government, we have trust in the constitution. Therefore, we put our money in Indian government, and we expect that bare minimum return which the government pays. But that's not the case once we move out of India and start participating in the international debt markets. So I need to know what kind of risk the Romania presents. In that case, Romania needs to be Romania's credit worthiness needs to be certified by a third-party ratings agency who is supposed to be an expert in providing credit rating metrics. So even governments need to be rated. Apart from that, in India we see semi-governmental institutions or government agencies like a Rural Electrification Corporation or a National Highways Authority of India. Agencies like this coming out and issuing bonds, and some of us would have invested in them as well, because some of them offer tax-free rate of interest, and we treat them safe investments. Even these companies need to be rated, because a National Highways Authority of India carries different kinds of risk as compared to a Rural Electrification Corporation of India. Because we may not know, a retail investor or a common man may not know how much the government is holding in this company, or how much is the company entirely government-owned, or is it semi-owned by government, or what kind of support the sovereign is going to give this kind of a corporation. In case if the corporation is not able to repay our money back, will the government step in and pay the money? So these are the, and what are the revenue streams of this organization? Okay, fine, National Highways Corporation is mandated to lay, say, some 1,000 kilometers of roads in India, but who is going to pay for those roads? Is it going to be collected from the taxpayers' money, or corporation, or are these contracts going to be leased to subleased to some other private players who then pay for this? Someone has to pay for it, right? So we need to look at the revenue streams of these projects. Therefore, even agencies like these, semi-governmental agencies, need to be rated by credit ratings agencies, and depending on the rating they get, their ability to raise funds in the market is determined. Sometimes even banks do raise money in the markets. Banks and other financial institutions like insurance companies, they are called frequent issuers, especially in developed markets. Banks and financial institutions are called frequent issuers because on a day-to-day basis they raise funds in the market at a cheaper rate, and they lend to either common man or they lend to either corporations at a higher rate, and thus making the spread of it. So banks do participate in these bond markets on a regular basis. Therefore, banks need credit rating. For example, SBI needs a credit rating. SBI has a credit rating. The same way every other bank has a credit rating. Axis Bank, I believe, raises funds in the dollar market. So we may know SBI, but someone in the United States, an investor in the United States, may not know what SBI is. So he needs to know what kind of company is it. He needs to know whether it's a government or a semi-government or a organization. He needs to know its financial strength before investing in that. So once we move out of India, especially once we move out of India, and once we are targeting international capital markets, everyone, right from governments, financial institutions and corporations, they need to get their credit rated so that it improves their chances to raise money in the financial markets. That's what the slide speaks basically. And the ratings report, basically the rating is a number. It can be a number, but in most cases it's a alphabet. It can be an A or a B or a C, and various connotations are given to these. If it's an A, it's a safe security. If it's a C, then probably one should not invest in that security. B is somewhere in the middle. And these rating, the final alphabet, they change from agency to agency. There are quite a few agencies in the international arena, and they have their own rating scale. So we'll get to there once we move ahead in the presentation. But in the meantime, if you have any question, just throw at me, because that's probably the best way to take it forward, rather than having it as a monologue. Because I'm used to monologues, because I also teach at some of the schools where people don't ask questions, so I continue speaking for hours and hours. So if you have any questions, just break it and just put it across so that we can move ahead.
So you mentioned all these people require rating.
Yeah.
Or people who want to invest want to know about the company.
Right.
In fact, what I feel, if people want to invest, have to know only the rating.
Right.
Irrespective of the ownership, all this, they go by if so and so rating agency has said, okay, this is A rated, irrespective of ownership or its
yes.
other criteria.
Yes.
I can go by it.
Yes.
So I don't have to look at any of those other criteria.
Absolutely. So as you said, if there is a benchmark or there is a parameter which is accepted across the market, then I need not go into the details that we are talking about. I need not know what the ownership is, and I need not know what the financial profile is. I can just trust the rating. If it's a A-rated, as you said, if it's an A-rated company, I'll blindly put my money and I expect X percentage of return on it. If it's a B-rated company, then I put my money and probably I expect more return because it's rated low. So for an ordinary investor, the ratings is a quick reference for investment. Although none of the ratings agencies in the world, they claim that if you go by my rating, you will never fail. So they're only indicative measures, whereas the actual analysis or the actual risk bearer is still the investor. But they provide a very good reference point for investors to invest. That's a wonderful point, actually. So it actually saves us from all the analysis and all the exercise in arriving at the credit worthiness of a particular issuer. It's a quick reference point. In fact, having a credit rating, a ready reference credit rating, improves liquidity, because investors, when they know, looking at the rating of a company, that this is the risk involved and this is the return I can expect out of it, it speeds up, it hastens the process of investing. I don't have to wait for, quite often we see that if I go for a 5 crore, if my company goes for a 5 crore loan proposal to a bank, then SBI sits on the file for a couple of months, and then they move it from the branch office to zonal office, child office, and a lot of procedure is involved. Whereas when we intend the capital markets to be liquid, ratings actually improve the liquidity in the markets by facilitating faster trading, by facilitating faster investments. That's actually a very wonderful point. But just as we discussed, individuals don't need to be rated. I mean, the reason is individuals don't issue bonds. I can't issue a bond by the name Lakshmi Prasad 5% bond. We don't need. I need to be either a corporation or some other form of business so that I can access the market. If I'm an individual, I can straight away go to one of the banks, probably SBI, and put a loan application, and probably they'll sanction it to me. Therefore, credit rating agencies, while they cover sovereigns, agencies like Rural Electrification Corporation and other governmental agencies, they cover financial institutions like banks and insurance companies. They also cover corporates. They don't cover individuals because they don't need to cover, because individuals don't issue any marketable securities. Not just the governments, there are some other forms of entities which are called supranational agencies. For example, these are bigger than governments. For example, the European Union is a conglomerate of probably 10 or 12, 15 countries. including France, Germany, Spain, Italy. So European Union is an umbrella organization for all these continental European countries. And this union is called, it's bigger than a sovereign, it's bigger than a government, therefore they are called supranational agencies. And there are quite a lot of supranational agencies in the world right now, especially in the European Union, in the European zone. We have European Union, we have something called European Stability Mechanism, we have something called European Financial Stability Fund. It's a fund of various different countries, and they're incorporated as an entity, and it raises funds for countries like Italy, Germany, France, and other countries in that region. So even they need to be rated, because that becomes even more difficult to understand the risk. For example, if there is an umbrella entity which has both Germany and Portugal and Greece under it, then how will the investor know? Because Germany is a strong economy, whereas Portugal and Greece are broken economies. So in that case, if I say, they may call it as, say, European Union, but I don't know what countries are involved in it. Therefore, it will be extremely difficult for an ordinary investor or even seasoned investors to understand the risks, how much to invest and how much to expect out of it. In such case, again, ratings agencies come to help, and they provide with detailed ratings analysis as well as the score, rating score, or we just call it a rating. In that case, it's in the interest of the issuer, it can be a country or a company, to get themselves rated. For example, if Infosys is getting rated and I am a company whose name nobody knows, I don't get rated, I am at a disadvantage. Because if a well-known company is getting itself rated and if it's getting a good score, then people try to benchmark other names in the industry to that well-known company. So suppose if Infosys gets an A rating, I don't think Infosys is rated because it never issued any debt. But just for the purpose of the discussion, if Infosys issues a debt and it gets an A rating, then its competitor, it can be Wipro or Cognizant, it cannot afford to be unrated. Because the investors in the market will definitely look at Infosys and say, okay, Cognizant doesn't have a rating, probably there are risks which we don't know, so keep away from it. So even there, it's in the interest of the issuer to approach the credit ratings agencies and get themselves rated.
Does it help to have more than one credit rating agency to rate you?
It certainly helps. I mean, the more is always better because, again, as you know, there are many credit rating agencies. Some of them are local, some of them are international. At least at the international level, there are 3 big rating agencies, but at the local level, there are many. And when I say local to India, there can be a company which is present in Botswana, India, and also in Indonesia. In that case, local means 15 ratings agencies, 3 in Indonesia, 3 in India, and probably 4 rather in Botswana. So more definitely is better because it averages out the rating. For example, a crazy ratings agency might give a Infosys a B rating, even though it knows that Infosys is a good company. It can always say that, okay, I did my own analysis and based on that analysis I am giving only B. And my rating is mine. If you don't want, please don't take it. In that case, if I have 10 other ratings agencies which are rating me A, it averages out the rating and the average rating will still be A. This crazy rating agency will be sidelined. So it definitely helps to have more than one rating. Any issuer should ideally go for at least 2 or 3 ratings, which is more beneficial for them. It improves their visibility as well. This slide basically talks about who approaches whom. It's the issuer of debt securities. It can be a bond or it can be sometimes a tradable loan. They approach credit ratings agencies to rate their credit at a corporate level or at a security level. So that investors in debt markets, it can be banks, financial institutions or pension funds, or it can be LIC, because LIC, companies like LIC, they are insurers, they have huge funds lying with them. All the premiums that we pay, they just lie with them because not as many people die as they expect. So those funds need to be parked somewhere. Sometimes, in a conservative economy, probably only they're allowed to invest only in government securities. But in some other economies, they allow them to invest in corporations as well as in government agencies, which give them a better return. So in that case, these investors, all these become investors. They need to understand the risk of what they're investing into. So the ratings given by the agencies are used by these investors. And at the same time, depending on how the rating is, depending on whether the rating is great or not great or somewhere in the middle, the cost of raising funds for that issuer varies. If I'm a high-rated investor, I can probably raise funds at much cheaper rate as compared to an issuer whose credit rating is not great. I believe, again, drawing a parallel to the personal loans, individual loans. If I have better creditworthiness, if I have better pay or a better security, the banker might reduce the interest rate, whereas if I don't offer a security, they might ask me a higher interest rate. So it's the same principle there. Again, well, it is also probably interesting to the audience to understand how ratings agencies rate these, because we are all chartered accountants and we are supposed to be experts in financials. Therefore, probably also go and look into the methodology of the ratings agencies. How, if I'm a ratings agency and if an issuer or if a company or a government approaches me and say, give me a credit rating, what will I do? Probably it's similar to what the credit risk management team does in the banks. Whenever a company or a customer applies for a loan, the loan goes to the CRM team. They do all sorts of analysis, they do some quality checks, and they either approve or they reject the loan. So ratings agencies also follow similar methodology, and this methodologies, since the kind of clients they cover or the kind of entities they cover are so diverse, they're as diverse as a government to a corporation. It can be a bank or an insurance company. Therefore, the ratings methodology, the methodology they use to rate these companies or entities differ from sector to sector. They can't use the same methodology of a bank to a corporate, or the methodology that they use for a real estate company to a pharma company. So this changes. But primarily, they look into not just the financials. They definitely look into financials. They look into the financials, they look into the liquidity aspects, they look into the leverage, coverage, and all the ratios that we talked about. But they also look into the qualitative factors. They look at management's track record. They look at, for example, a simple parallel would be Infosys has better track record as compared to Satyam, because Satyam was involved in an accounting scandal, whereas Infosys so far has impeccable record. Even though both the companies started around the same time, probably both the companies have similar kind of financial metrics, but since the track record is not great, Infosys definitely scores ahead of Satyam or some other company with not great track record. They look at the management background. For example, if someone who is into real estate suddenly ventures, or someone who is into some other business, it can be liquor or someone ventures into an airline, then probably that's seen as negative. Equity investors might be bullish about it because this man has made a lot of money in real estate and this man has made a lot of money in breweries, but therefore he can give us great returns in airlines as well. But credit rating agencies will be skeptical because the perspective of debt investor is always conservative. The debt investor's return is always capped. If I fix my interest rate at 10%, it's 10% throughout the life of the instrument. It will never go above that. I'm only concerned about whether this company will be able to pay the stated or agreed rate of return, and whether this company will be able to pay me back the money I lent it at the end of the life of the security. So therefore, credit ratings agencies tend to be conservative. If the management's track record is in a field which is not related to the current venture, then probably that is seen as negative as compared to equity investors. And obviously, the huge section, or at least 40 to 50% of the weightage in the ratings is given to the actual financial analysis. They also look at the operating metrics, like if it's an airline, then they look at the number of fleet they have, the number of licenses they have to operate in the various airports. Not every airline has a license to operate in all the airports, so they have to pay for these licenses, I believe. So these metrics are also looked into. So maybe, any questions here, or anything you want to share from your own personal experience, or have you ever come across a situation where you have to assess the creditworthiness of an individual or a company, in which case probably you can share your own experiences and perspective here.
So now CIBIL is there to evaluate individual creditworthiness.
Sorry, CIBIL. Yes, but CIBIL only talks. CIBIL is black and white. Either your credit score is great or your credit score is not great. But within the people whose credit score is great, it doesn't further qualify. For example, CIBIL might say my credit score, Mr. Lakshmi Prasad's credit score is bad, then I will not get a loan. If it says it's good, then I'll get a loan. But within good, it doesn't differentiate between a Lakshmi Prasad and a Vijay Mallya or an Narayan Murthy.
So I think I believe it's a number.
Okay.
It's based on uploaded information.
Okay.
But it's a number. So somebody may get score 900, somebody may score 500.
Okay.
And somebody may score 200.
So the higher the score, the better is the creditworthiness. So yeah, in that case, it's more or less similar to.
In fact, it's more fine compared to A, B, C. Only
Okay.
three categories.
Right.
There you have
Right.
900 categories.
Right. Exactly. Probably that kind of gradation is possible in the case of an individual because the numbers involved is pretty simple. Whereas when we are rating corporations, we only look at broad categories or broad brackets. But yeah, that's a good parallel because from a principal point of view, it's the same. So just moving ahead. Again, as we discussed, the users of credit rating agencies can be all these. Banks definitely invest in bond markets. Banks put their money in bond markets, some of the money, not all. Those that come under RBI scanner probably are more restricted, but banks these days are also selling other value-added products. They come up with some money-back plan or some other insurance plan along with your FD. So those money can be put in the financial markets, especially in the debt markets. So they need to know when they're investing, the asset manager hired by the bank needs to know the credit rating of these companies they're investing into. And naturally, financial institutions like insurance companies, non-banking financial corporates, someone like a Shriram or maybe Bajaj Capital, they all fall under the non-banking financial institutions sector. Even they invest in bond markets because if they have excess funds, they would like to put them in avenues which give them probably 100 basis points or 75 basis points higher return than what they get in a FD or. So hedge funds. I don't know if we have hedge funds in India, but hedge funds are a phenomenon in the international credit markets. Basically, these are group of private people. It can be people, individuals, or it can be corporations. They come together, they put in private money, they don't raise money in the market, so they are not accountable to anyone, but they do raise money privately. Probably they approach all the rich people in the world and take some money from them, and they invest in financial markets, both in equity and in debt. So they need to know the ratings of the securities that they are investing into. Governments also put their money in, for example, Indian government might want to invest in US treasuries for whatever reason. So Indian government needs to know what is the creditworthiness of US. Is US doing good as compared to UK, or is US doing not good as compared to Japan? This needs to be known because that determines how much amount needs to be put in each of these securities. And the last ones are retail investors because these guys are the ones who are always in dark. They get to know very little of what's happening. So they need ratings more than anyone else. That's what I believe because these are the ones with least amount of access to information and proximity to the security that they're investing into as compared to others. So they need to know what the rating of a security that they're investing in. I mean, it's pretty self-explanatory. If a company's rating is poor, then it has a high risk of being defaulted, high risk of defaulting on that security. And higher the rating means better is the security for that investment. I think this we already covered. And when we talk about ratings, especially ratings are important in bond markets, because in loan markets, for example, if there is a bilateral loan, again, the rating is done by, the assessment is done by the bank itself. Or if there is a syndicated loan, if there are 2 or 3 banks that have come together and lending the borrower, then they again do their own ratings assessment. They don't need to make it public. But the need to make a credit rating public arises only when there are tradable securities. For example, the loans that are issued by banks are not tradable in a broader market. Even loans are tradable, but they are traded among the banks. For example, the loan book of Axis Bank can be bought by SBI, or the loan book of SBI can be bought by some other bank, but they move within the bank and there is no liquid market for them. Whereas, in the case of tradable securities, for example, corporate bonds or sovereign bonds, these are traded in exchanges similar to our stock exchanges. So there are bond market exchanges and there are bond market indices. The way we have Sensex for stocks, the way we have Nifty for stocks, we also have in developed markets certain indices for the bonds. So one example I may give would be iBox. There is something called an iBox which is similar to Sensex for bonds, but it focuses more on the European bond market because the Indian bond market is not developed at all. It's limited to some of the governmental agencies as well as some high-rated companies. We have very few high-rated companies in India. So Indian stock market Indian bond market doesn't have the required depth. We ideally love to put our money in a fixed deposit or probably buy some bonds by one of these RECs or NHIIs, the retail investors. They don't go beyond this. Part of the reason is the interest rates in India is pretty high as compared to Western countries. We get about 8 to 9% on fixed deposit. Even after tax, it turns out to be probably 6.5 or something. So it's still more attractive as compared to USA, where 2% return is given for a 10 years security, which is pretty less. Therefore, we tend to put our money in banks rather than invest in the bond markets. Whereas in European and Western countries, since the interest rates are pretty low, the investors are forced to look at avenues other than the traditional banking system. So they look at probably the bond market, they look at some other market, like there is something called Schuldschein market. I mean, it sounds pretty funny, but there is something called Schuldschein market in Germany, which is nothing but a kind of loan which can be traded. So they created a security which is a hybrid between a bond and a loan. So it's essentially a loan, but you can take that loan certificate and trade it with someone else in the market. So they look at avenues other than the traditional banking system. Therefore, the depth, the money that flows into international bond markets is much higher, the liquidity is higher, and the trading volumes are much higher. We do have a bond market actually, so we call it the wholesale debt market segment of the BSE or NSE. But the investors are mostly companies like LIC, UIC, the government agencies which have tons and tons of cash lying there, and probably some corporations, big corporations like a Reliance or a Tata, but not all. But below that, nobody invests in debt markets because there is no market there.
Sir, are there huge profits made in these or losses incurred?
If we are in the global context, most money is made in bond markets than in equity markets. For example, if you move out of India, in India the craze is all about stock markets. If the stock markets go up, then people like Rakesh Jhunjhunwala are shown in the Economic Times front page and all that. But which is the case in developed markets as well. but the people who make most money are the ones who invest in fixed income securities or the ones who trade in fixed income securities. Because the volume of outstanding, total debt outstanding, I read somewhere it's about $82 trillion is the total volume of debt outstanding. So that much of, when we trade $82 trillion or $90 trillion, the spreads that these people make are more as compared to what people make in the equity markets. Therefore, debt markets are huge and they're definitely profitable. And the trading cycle is more fluid and it's probably I can say the liquidity is more because equity doesn't have a life. Once if I issue shares, I'm not supposed to pay it back. So I can raise money, I can hold it for life, and I can say the company has made losses and I don't have to give you the money. Therefore, but in the case of debt, if I raise say 500 crores in the form of a bond, that bond comes with a fixed life. It can be 3, 5, 7, 10 or even more. So at the end of the specified period, the CFO or the treasurer has to search for funds to repay this money and go for a new loan. So therefore, every year, each company and for each country, or it can be anyone, each agency, some part of its debt retires or expires. In that case, they'll have to fetch money somewhere to repay this the existing maturity. For example, if there is 500 million every year to pay in terms of debt repayments, then every year I'll have to go into either a bond market or a loan market to fetch 500 million and repay. So the trading volumes are much higher in debt markets, and that's where the bankers make a lot of money. Because since the total amount of capital in circulation is higher, they tend to make a lot of money in that. So yeah, to answer your question, they're profitable. Coming back to ratings, the ratings can be long-term and short-term. So it again depends on whether we are looking at a long-term debt or a short-term debt. For example, I can't apply the same methodology or the same rating scale for a commercial paper, which is short-term. I think in India it's only 270 days. So if I raise a commercial paper today, probably I'll have to pay it back after 270 days, which is less than a year. I can't use the same rating scale for a commercial paper and a long-term bond, which is about 10 years maturity. Because while my short-term credit rating is great, which means that if I invest in Reliance's commercial paper or say SBI's commercial paper, SBI is in a position to repay it back much ahead of a year. That may not be the case with a security that the SBI comes up with a longer lifetime, say 5-year or 10-year. Because its short-term liquidity may be great, but in the long term it may not have that much of liquidity. And the long-term ratings are more driven by the companies or the country's cash generating capabilities. So what kind of profits, profits lose relevance when we talk credit, because profits, when we say profit, the profit after tax that we talk about, it has so many items which a credit investor doesn't need. For example, a credit investor does not care about depreciation. A credit investor does not care about amortization. So they deduct all these and they look at the EBITDA, which is probably a proxy for the operating cash flows of a company or an entity. So the long-term ratings are more driven by the cash flow generating capability of that business. So the inherent strength of that business. And long-term ratings are also driven by the existing debt. So as we all know, any business can be run either by equity or by debt. For a project manager, it doesn't matter if it's equity or debt. For him, it's just debt. It's the problem of the treasurer or the CFO to see which form to invest in, because equity has certain cost, debt has certain cost. Equity comes with certain considerations, debt comes with certain considerations. Therefore, it's a problem of the CFO and the treasurer. But for a business manager, it doesn't matter. For him, it's just money. It's 100 crores, whether it is debt or not, or equity. Therefore, the long-term credit ratings are also influenced by the debt the company is currently holding and its cash position. If it has already a lot of debt in it, then it's all the cash that the business generates goes into servicing the debt, the existing debt. Therefore, if I lend the person or the company further amount of money, my money may not be paid back first because there is already someone who has lent to the company. So the leverage and coverage ratios, they play quite a big role in deciding the ratings of in the long term. Short term, the considerations are different, and we probably let's try to restrict our discussion to long term because short term will be too cumbersome to discuss at this level. Any question here? Okay. And when I say rating, there is a issuer or there is a borrower. This borrower has raised two kinds of debt. One debt is unsecured. He hasn't provided any security on that debt, and the banker lent the borrower. The other form of debt has a security involved, and the banker says, if you don't pay me back my debt, I'm going to sell off that security and make sure that my money is back. So in this case, if I say this particular borrower, say it is Reliance, has X rating, say a single B rating or a double B rating, does it apply to all the debt the company raises? It certainly does not. So wherever a structure is involved, when I say structure, wherever a security or a guarantee or an access to cash flows is involved, the ratings of that particular debt changes. So within an issuer, each set of or each security can be rated separately. Therefore, when we talk about ratings, we talk about issuer ratings, which is the corporate level ratings. When we see only the balance sheet, the P&L, and we do those analysis, we find out leverage, coverage, and we give it a rating. And we also talk about the other rating, which is the issue rating. When I say issue rating, this particular bond issuance comes with a guarantee from the Government of India. Reliance might have issued a debt security which doesn't have any guarantee of security, but this security which it is issuing now has a guarantee from the Government of India or some other prominent agency. Then obviously this debt's rating is higher as compared to the other debt. Investors will be more willing to put their money in the security which has a backing of the Government of India, which has a backing of the promoter group, as compared to a debt which doesn't have a guarantee or a backing. Therefore, when we talk about ratings, we talk about both the issuer ratings as well as the individual issue ratings. Also, each company, when we talk about huge companies and especially multinational companies which are operating in multiple geographies, the company may be having 100 subsidiaries. For example, there's a company called ArcelorMittal. Probably, I'm not sure if it's present in India. I think it has a plant in Chennai or somewhere. But do you know this company? Yeah. So basically, or maybe Lakshmi Mittal sounds much better because we think he's an Indian, so our newspapers cover him more than the British newspapers. But he is a British citizen and the company is a British company, so he has nothing to do with India. That apart, this company Arcelor and Mittal was formed by joining two companies called Arcelor and Mittal Steels. Arcelor is a French company which at that point of time in 2008 was the second largest steel company in the world, whereas Mittal, it's a British company, it is the largest company in the world. So when these two companies merged, Arcelor may be having X rating and Mittal may be having a Y rating. So when these two companies merged, what kind of rating they are going to get is a big question for the ratings agencies. And more so because Arcelor has subsidiaries in Canada, in Tanzania, in Kazakhstan, and Mittal has subsidiaries in Australia, Africa, and some other places. And each of these subsidiaries are separate legal entities. Even though they are held by a same parent, they are separate legal entities in the countries in which they are operating. And they have their balance sheets are different from the parent's balance sheet. So when we know very well the difficulties that we face while consolidating accounts. So each balance sheet is different and each balance sheet speaks a different story. And debt might have been issued or money might have been lent based on each individual subsidiary balance sheets. and there may be a separate funding at the corporate level. In this case, the risk profile of the subsidiary operating in, say, Canada is different from the risk profile of a subsidiary operating in India. So we also come across the ratings of a parent company and the ratings of the various subsidiaries. This can be different. The rating of the parent company, which is the group company, can be very bad, whereas the rating of this particular subsidiary operating in India can be great because of its own individual financial situation and metrics. So when we talk about the type of ratings, while we have both issuer and issue ratings, we also have parent company level ratings and the operating company level ratings. Typically what happens is most of the companies, especially in long-term infrastructure projects, they operate on SPV basis, the special purpose vehicle. The group can be anything, it can be a GMR group, but when they want to build a port in, say, Visakhapatnam or somewhere in Goa, they float a company with a different name, with a different set of promoters, and with certain stated objectives. They will say GMR Ports Limited or something. It's a special purpose entity, and this special purpose entity is floated by the sponsors, and the sponsors might have put in some money with an agreement that come what may, money will not be taken back from this project. So the sponsors might have said that, okay, so long the infrastructure project runs, no cash flows can be taken out of this business and repatriated back to the parent. In which case, even though the parent company's ratings are not so great, the SPV's rating will be SPV will be given a higher rating because the risk return profile of the SPV or the subsidiary is totally different from the parent. So these issues crop up while rating multinational corporations and huge companies with multiple subsidiaries. Do you want to add anything here, or any question, or probably any thought?
So in this long term,
Yeah.
I'm just saying it's like comparing with debentures.
Yeah.
Debentures, when they are issued for a specific term,
Yeah.
as per our I think Indian laws,
Yeah.
we are required to have a redemption fund.
Right.
And we are by the end of the when the debentures are to be redeemed, we should have enough funds to redeem it.
Correct.
Are there similar rules for the other bonds and all?
Actually, to be very frank, I've seen debentures only in Indian companies. So in European and US and Japanese companies, I haven't come across debentures. Probably 1 in 1,000 I would have seen, but the volume is pretty low. The reason itself, yeah, please.
But do the similar requirement applies for the bonds?
It doesn't, because putting such a requirement will reduce the attractiveness of the instrument, and the instrument will become less and less tradable. And companies, obviously, if they have to create a debenture redemption fund and raise a debenture, they might as well go to a bank and say, just give me a loan. So that actually kills the market, because if the more clean the indenture is, the more tradability is, the more liquidity is. If it comes with strings attached, say it has to have a debenture redemption fund, or it has to have a lien on the assets, or a charge on the assets, or maybe some kind of a promoter guarantee, then the less tradable it is. So in order to make trading possible, in order to increase the depth of the financial markets, bonds, plain vanilla bond doesn't come with any such requirement. And this phenomena is possible in developed markets because the companies are so huge. If we take the example of General Electric, I believe it's a 150-year-old company, and it is a company in which Thomas Alva Edison started. So companies with that kind of size and that kind of reputation can afford to issue a bond without any strings attached, and investors will still invest in it because of the trust they have in it. So, unfortunately, in India, we are still stuck with debentures. We are still not active in corporate bonds. Probably for reasons which are best known to us, because we have seen Satyams and other scandals here. So, probably Indian investors are not ready for that kind of risk.
Sir, to look at it from a different angle. For example, bonds issued by banks.
Yeah.
The Reserve Bank says this is in tier 2. Tier 2 bonds issued by banks. Reserve Bank says after say 5 years or something, the risk rating will be different.
Yes.
For capital adequacy.
Right.
It will come to a different rating level compared to capital requirement will be different
Right.
for a long debt which is payable after 5 years or 10 years,
Right.
and for which is payable which is within 1 year, 2 years. Is there a similar thing applied here?
Yes. Yes and no, actually, because in the case of Reserve Bank, since they have to adhere to the capital adequacy ratios and the capital adequacy norms, obviously a debt issued by an issuer for a longer term is less risky as compared to a debt which needs to be paid back tomorrow or day after tomorrow. Because a long-term debt will give me the flexibility to operate for say 5 years or 10 years without thinking about the repayment. So the closer an issuer is to redemption, the riskier the security is. Therefore, if say banks issue a 10-year bond or an instrument, tier 2 instrument for 10 years, after 5 years, certainly it falls into a bucket which is more risky as compared to when the redemption is 10 years. I might issue a bond for this 2014. A 10-year bond would mature in 2024. But 5 years down the line, the maturity is only, when we are at 2019, the outstanding maturity is only 5 years or less than 5 years. So that instrument suddenly turns risky as compared to when it was issued. Therefore, the regulator suggests that the risk profile will shift after 5 years or 7 years, or depending on the current regulation at that time.
But similar thing will apply.
Similar thing applies to actually. As I said, it's yes and no. The reason is the kind of return investors expect on a 10-year bond is different from the kind of return investors expect on a 3-year bond. On a 3-year bond, since the investor knows that his money is going to be repaid within a short period, they expect a smaller return or a lesser return. In the case of a longer bond, say a 10-year or 15-year bond, they know that their money is going to get locked for a longer period, therefore they demand higher rate of interest or higher rate of return. So this rating change that you're talking about is taken care by the pricing. Whereas in the case of the Indian bank, where it still has, I'm just asking you probably, would a 3-year fixed deposit carry a higher rate of return as compared to a 2-year deposit? There is a difference, right?
Slight difference.
Slight difference, but the difference is slight. Unfortunately, in India, the pricing doesn't take care of the risk profile entirely. Whereas in liquid bond markets, in established bond markets, this risk is being taken care of the pricing. So the additional risk that a person is incurring or getting into by investing in a longer term bond is compensated by the interest that the bond pays. For example, a 3-year bond might carry a 3% interest and a 10-year bond might carry a 6% interest.
No, sir, does it mean then, both are issued as a 10-year bond only? Now the residual period is only 3 years.
Right.
So that means in the market it will command a premium.
In the market it will, no, actually,
because the rate is higher and maturity is only 3 years.
no, actually the way, that's what exactly happens. So when the bonds are traded in the market, they're the price is fixed, but the spreads vary. For example, when I issue a bond, say at 100 with a 5% interest, after 3 years, the spread, the secondary market spread comes down. It will no longer be 5%. Whereas the fixed interest will be paid at 5%, I'll have to buy the bond at a higher price. As you said, since it has suddenly become more attractive, I'll pay a higher price. For example, if the bond is issued at a par value of 100, now I'll have to pay 102 to get the same bond, which actually reduces my return on it. Therefore, the spread comes down. So the actual attractiveness that you're talking about is taken care by the market by reducing the secondary market spreads. This is the way our shares trade. The bonds also trade, and their spreads also vary on a day-to-day basis. Therefore, it should be paid as compared to when we invest at the time of the issuance. Probably that answers. I've made an effort to answer your question. Probably that satisfies.
Thank you, Alan, sir. Thank you.
Yeah. So, in the international arena, while there are many ratings agencies, small and big, three are very prominent. Just the way we have big fours, we have this KPMG, PwC, EY. In the ratings area, there are only three which are very prominent. There are others as well, but they are not as prominent or as important. In no order, actually Moody's, Standard & Poor's and Fitch are the ratings agencies which are most sought after by the investors. Among which Moody's and Standard & Poor's command a greater respect as compared to Fitch, because Fitch coverage universe is less as compared to others. Almost every company which issues bonds in international bond markets, they approach at least Moody's and S&P, at least two ratings agencies, before they issue the bonds. For example, Reliance issued a dollar bond last year, and I think recently Bharti Airtel Group has issued a dollar bond. So they get themselves rated by Moody's and S&P. Moody's and S&P more or less are standard. We see them everywhere. Fitch, sometimes they do approach Fitch, sometimes they don't approach Fitch, but Moody's and S&P are standard. So, for example, someone sitting in Luxembourg or London or New York investing in fixed income securities, if as an investment banker I say that there is an Indian company called Reliance, he doesn't know what it is. In India, Reliance is a household name, but outside India, people don't know what Reliance is. People probably would recognize Mukesh Ambani's building better than Reliance logo. So, because it's much talked about. So, therefore, they look at the ratings agencies. Again, they look at the rating and they get an assessment of the risk return profile of this company. How it is beneficial to Indian issuers is quite interesting, because in India the interest rates are high. Probably Reliance wants to raise money in Indian markets either by way of a bond or by way of a loan. A 10-year instrument would cost them about I don't know, maybe 10-12% for a corporate issuer, or maybe if the credit is good, probably 11% or 10%. But Reliance was able to issue $1 billion US dollars for about 5.125%, and the maturity is perpetual, which means that Reliance doesn't have to repay the security forever. These are structured instruments. Perpetual securities are structured instruments which are essentially bonds, but since they are perpetual, they are never going to be repaid back. Usually in such transactions, the investors ask for a step up. For example, I'm fine with investing my money, say 100 crores, in Reliance Industries forever, but I say after 5 years, let the interest rate go up from 5.125% to 7.5%. So basically, the step-up clause disincentivizes the issuer, or in this case Reliance, to hold that debt beyond 5 years. If it wants to hold the debt beyond 5 years, either the credit market conditions have worsened so that Reliance is not able to repay the money back, or Reliance is making excellent profits and probably it wants to doesn't want to disturb its existing debt. Therefore, investors look for a step-up clause, a coupon step-up clause. But in this case, Reliance has achieved another feat. There is no step-up clause, which means that it can hold the debt for as long as it wants without giving any coupon. In fact, this is more attractive than equity, because equity investors typically expect a return between 15 to 17 or 20%, depending on the industry they invest in. Whereas this person, in this case, Reliance is paying the debt investors only 5.25%, and it's as good as equity because they don't have to pay it back. So, Indian issuers, especially the big ones like say Reliance or Tata Motors or Bharti Airtel, and the big banks, they all, Axis Bank raises money in dollar market, ICICI raises money in dollar market, SBI does. So they are looking for cheaper funds, because increasingly, especially in banking industry, the spreads are getting tighter and tighter, and as RBI is allowing more and more banks, the competition is so intense that unless the asset base is too huge, the banks won't be able to make substantial money. In this case, access to cheaper funds is a boon for them. So, within the framework of the ECB regulations and other regulations, big issuers are still able to raise money in international bond markets, especially in the dollar and the euro markets, and at a cheaper rate, and they're able to make good spreads on it. But unfortunately, such a facility or such a benefit is not available to the lesser known companies or smaller companies. They still struggle with the local banks, they still struggle with the local non-banking financial corporations. I've also seen some companies about 1,000 crore, 1,500 crore in Andhra Pradesh that have issued FCCBs at some point in time. But at that point of time they were attractive, but in the last 3 to 4 years, since the equity markets were not performing well, even that market dried up. I'm just hoping that with the recent rally in the markets, FCCBs pick up again. Maybe again, any questions or observations or?
So this 5.15%, whatever is the rate there.
Yeah.
For Reliance, it may have some impact. It cannot remain at 5.15, depending on the forex rate, exchange rate between rupee and the US dollar. They may have to pay more.
Yes, that's a valid consideration. So whenever a corporate is raising funds from outside India, say a US market or a Euro market, if they intend to bring back that money, convert that money to Indian rupees and use it within India, then exchange rate also plays a huge role in the kind of return they are going to pay.
I'm talking about servicing of the debt.
The same applies to paying interest as well.
Yeah.
So if the exchange rate goes up, then they might have to pay more interest. But typically when investment bankers advise these huge corporations, it is advantageous only to huge corporations because they operate not just in India. Reliance has oil wells across the oceans in the world. For example, a company like, say, ArcelorMittal, it is a British company, but it doesn't have any assets in Britain. It has its assets in Kazakhstan, it has its assets in Tanzania. So therefore, their money needs are in different currencies. For example, Reliance or some other company may have to pay a supplier in US to the tune of $500 million or $100 million in dollars. In which case, if that particular company raises funds in dollars, it doesn't have to convert that money back to rupees. It can pay it there itself. So this is a very good consideration when investment bankers advise corporations. For example, in the case of ArcelorMittal, most of ArcelorMittal's assets are in, some of them are in China, and they have huge payments pressure from China, in China. They have to pay in Chinese yuan, it's also called renminbi. Therefore, the bankers advise them, why not raise in Chinese currency itself, use that money to make the payments in that home currency without converting it into dollar or euro. So that works. So when a huge company is operating in multiple geographies and it can have debt in multiple currencies as well, depending on their payment needs or corporate users.
But is this 5.15% a competitive rate in a foreign country, for example, US?
In US, it's an excellent rate of return for them.
Compared to borrowing from a bank in US?
Borrowing from a bank in US is going to be difficult because banks put their balance sheet behind the loans. For example, if I'm a bank, if I'm SBI, I raise say 100 crores in deposits from people like us, common people or from corporations, and I can, given the regulations that apply to bank, it can lend probably only 80 or 85 crores, and it has to put some money as a cash reserve ratio, statutory liquidity ratio with the RBI and with government bonds, and it can only charge a particular amount of interest from its borrowers. I mean, a bank probably cannot charge 25% interest from its borrowers.
So what I want to understand is, see, deposit rates are so low in US.
Right.
Say, as you said, 1 or 2%. So lending rates also will be
they're less.
So if Reliance is taken at 5%, it is higher than the bank borrowing rate.
Yes, I mean, that's what I'm trying to arrive at. But the problem is the quantum of funds. The quantum of funds that a company like Reliance needs is to the tune of billions of dollars. Banks may not be in a position to lend them unless they become a syndicate. That's why we see syndicated loans happening. A single SBI or a Bank of America may not be able to lend $1 billion. 4 or 5 banks need to come together, put individual monies in it, and then lend the borrower. So that becomes very cumbersome. Bank funding beyond a particular size becomes very cumbersome and almost impossible for the reason that banks are not allowed to lend beyond a particular percentage of their deposit, the deposit that they have. And they have various restrictions. They can't invest in whatever kind of company they want, they can, because it's heavily regulated. Even bond markets are regulated, but the investors are different. The investors don't have any restrictions. For example, there is a hedge fund with about $20 billion in assets. It can invest it in whatever company it wants. There is no regulation for hedge fund. Therefore, the players in the bond market are different from the players in the loan market. In the loan market, it's mostly the banks and NBFCs. The situation is much difficult for an NBFC because the NBFC doesn't raise deposits from the common man. So they have to put in their own money, and we don't know where they are getting their money from and what kind of cost they are getting it from. So loan market is called sticky, and because of this stickiness, the loan rates are higher as compared to bond. So the entire idea of raising a bond is the company will be able to raise money at a cheaper rate as compared to the bank market. While the interest rate mechanism is same in the case of both bond and bank, the liquidity is pretty less as compared to in bank market as compared to bond market. And since there is huge liquidity in the market, since there is trading on a day-to-day basis, bond markets offer cheaper rate of interest as compared to the bank markets. And banks come with hundreds of strings attached. They may want a promoter guarantee, or they may want they put financial covenants. For example, I'll give you say $1 billion, but your financial leverage should not exceed 1.5%, which is not possible in the case of a mining company like ArcelorMittal or an oil company like ArcelorMittal. So it's easy to raise funds in bond market, and since it is liquid, the cost of funding is also much cheaper. And typically, if someone is raising money in the dollar market, and if it's a multinational corporation, they look at their payment needs or business needs in that particular geography. Only then they raise money. For example, a company operating in, say, Switzerland, it has suppliers in Switzerland and it has to pay in Swiss francs. It's ideal to raise money in Swiss francs and pay it there itself than to raise in dollars or rupees and then convert it and deal with the exchange rate fluctuations. So the Treasury Department of these huge companies and corporations, they take care of these kind of considerations when they raise funds in the market. Yeah, again, coming back to the agencies, among these agencies, sometimes Standard & Poor's is more aggressive and sometimes Moody's is more aggressive. Recently, Standard & Poor's went ahead and downgraded United States, which has always been a AAA rated economy. It has downgraded to AA. But the eventuality is the head of Standard & Poor's, who happens to be an Indian origin guy, was apparently asked to leave. I mean, they don't say that they have fired him, but we can see what happened because he left within a month or two of downgrading United States. So, but Moody's probably didn't follow that step because it was not too happy to let their chief executive go. So, and these rating agencies, as we see, I mean, they are not licensed by any authority. They are unregulated in the first place. There is no regulation which regulates the ratings agencies, and they are the individual opinion of that particular ratings agency. But since they have gained currency over so many years or so many decades, and probably since there is no other barometer to assess the creditworthiness of the companies, these rating agencies gain popularity, especially Moody's and Fitch. Actually, some time back I was sitting with the promoter of a huge company, probably I can name it, it's Vedanta. So that person asked me, Lakshmi, you know, the entire financial crisis happened because of the ratings agencies. because the ratings agencies took money from the issuers and they made some financial engineering and they gave high rating to a junk debt, which is subprime mortgages. Then why do we still have to trust rating agencies? Then I had no answer. I just said, show me something else which is better, then let's discard this. There is no other option at this current point of time, therefore we are continuing with them. But a recent study says that even though ratings agencies were blamed at the time of the financial crisis in 2007 and 8, of late, more so after 2011 till 2014, the profits of these ratings agencies have gone up multifold. Now they are operating at a net profit level of 50 to 55%, which is much higher than Infosys or any other company. The reason being, there is no other barometer. Everyone has to approach these companies, these ratings agencies. Even if Indian government wants itself to be rated, it is being rated by Standard & Poor's. And recently, I believe last year, Standard & Poor's threatened Indian government to downgrade it to junk if Mr. Manmohan Singh didn't take any initiative. So we are pretty much in the hands of these ratings agencies, even though they are not regulated by any authority, even though they are independent third-party rating agencies. They have quite a lot of clout in money markets and debt markets. Probably it will be interesting for the audience to look at how the ratings look like. For example, these three ratings agencies, they have their own rating scale, which are more or less similar. As you can see from the table here, Moody's starts with a AAA, A with two small A's, and S&P starts with three capital A's. So I don't know what the difference is between these two, but they both speak the same thing. They say that the debt is extremely safe to invest in. So such kind of privileges at one point of time was given to United States of America, the government, but now only Moody's rates it AAA, S&P is AA, I believe. And the rating goes way down till D. D stands for default, and that is standard across all the three ratings agencies, which means that there is no point. I mean, the investors who invested in this debt can forget about it. Basically, the company is no longer going to pay back. In between, there are many other sub segments. So, if you look at the horizontal line that is cutting across between the green color and the slightly violet color, so that's where we draw a line and say, if the rating of an entity, can be a corporation or a government, falls below BBB, it can be Baa3 or BBB minus, and if it goes to Ba1 or BB plus, then such a security or such an entity is called a sub-investment grade company or a sub-investment grade security. In other words, it's called high yield. There are multiple terms that are used. Some call it junk, some call it high yield, some call it sub-investment grade. But the idea is, it is not worthy to invest in this kind of companies at a competitive rate. So if someone wants to invest in these companies, then they are obviously looking at a higher rate of return, and therefore they are willing to risk their money. So and that's the reason it's called high yield. Whereas the ratings above the horizontal line are called investment grade or high grade. So they are supposedly safe to invest in, and investors can't expect higher rate of return there because it's a reliable security. And within the high grade, there are again A, AA, and BBB, depending on the relative strength, financial strength, and the qualitative factors. Each company is given a particular rating within the high grade as well. And the ratings falling just above and below the line are called crossover. For example, a Baa3 or a BBB minus is called a crossover. For example, India's credit rating is a crossover rating because with just one downgrade, India will become junk. For example, if India's rating is BBB plus, even if it gets downgraded by one notch, it will not be junk. It will still be investment grade. But India is standing here at a BBB minus in S&P's rating scale. Therefore, even a single notch down of rating is going to make India a junk country. Now, what are the implications for this? What happens if India is downgraded? Obviously, India has a lot of external debt, so it takes money from probably other countries and other international financial markets. The cost of funding for India, India's debt is going to shoot up like anything. So India will have to pay huge amounts in terms of annual interest payments if it gets a junk rating. That is the reason suddenly everyone, even the stock markets were a bit jittery, and everyone was talking about India's downgrade. So who is controlling India's fate? Some American or multinational ratings agency which is not regulated, which is run by private people. It is not in a government agency. So they are controlling India's Indian economy's fate or Indian financial system's fate. So that gives us a broad perspective of the ratings. In international bond markets, the bond markets are classified as high-grade markets and high-yield markets separately. Because the kind of investors that invest in high-grade debt, they don't invest in junk or a low-grade debt. For example, pension funds or the insurance companies, which are heavily regulated, they are supposed to play safe and put their money in the safest possible investments, because they are the retirement money of the people of the country. Therefore, they invest only in high-grade debt. So they don't invest in debt which is rated BA1 or BA2 or B. So the investors in high-grade market are different, and the investors in high-yield market, which is the sub-investment grade market, they are people. They can be hedge funds. A hedge fund guy may throw $1 billion into a single P debt just because it is giving him 10% rate of return. They don't mind, because in an alternative scenario, he would be getting probably 3 or 4% return. Whereas if he is putting his money in a single P rated security, he might as well get 8 or 10%, which is much higher as compared to the alternatives available to him. And since hedge funds are not regulated, they don't have to answer anyone. And since hedge funds, they don't raise money from public, they don't have to answer the public. It's their private money. They probably pull money from rich people and put it in securities which give higher rate of return. So therefore, the point I'm trying to make is the set of investors available for high-grade issuers are different from low-grade issuers. How does it impact a company which is on the border? For example, there is a company which is lying on the border, say BBB minus. For example, we just discussed about ArcelorMittal. ArcelorMittal's rating was a couple of years back BBB and BBB minus for a long time. But the company itself was formed by the merger of two huge companies, and it was a hostile takeover, because Arcelor, being a French company, the board and the shareholders were not willing to give the reins to some guy from India who they don't know. So they were resisting the merger, and we all read it in newspapers what happened. The merger was delayed for quite a lot of time, and the asking price was increased by quite a huge margin. But somehow Mr. Mittal was able to put his money, his clout. He went and met the British Queen. He went and met the United States President. He also came to India to seek support from the Indian government and Indian community, as if he's an Indian citizen. He is never an Indian citizen. I mean, right now he lives in Britain and he's a British citizen, and his company is a British company. So, but the point is, he somehow was able to convince or threaten the Arcelor shareholders and the board, and he was able to acquire that company. But in the process, that's a huge transaction. Two huge companies, they treated it as a merger of equals, as they call it. But in the process, Mittal, or the joint company ArcelorMittal, had to raise huge money in bond markets in order to fund the acquisition. The shareholders of Arcelor need to be paid off, the debt holders of Arcelor needed to be paid off, and this ran into billions of dollars. And they needed billions of dollars to pay them out. Therefore, they raised this huge money in bond markets by issuing bonds. So the moment ArcelorMittal, the joint entity formed, it has $27 billion of debt on its balance sheet. Therefore, its rating was BBB and BBB minus for a long time. It was seen as okay at the time because the world market was booming, and probably they didn't see the recession that was coming up in the coming years. But during 2010, 2011 and 2012, the demand for steel came down. The demand for steel came down rapidly because China stopped growing, India stopped growing, and most of the BRIC countries, they stopped growing at the rate at which they were growing at some point, at an earlier point of time. Therefore, the construction activity has come down, the infrastructure projects have come down across the world, and the demand for steel came down. It eroded their margins, it eroded their cash flows, and they were under intense pressure to repay the debt they have raised at the time of inception. They have about $27 to $28 billion in debt. So they were under constant pressure of getting downgraded to junk because they are standing at BBB minus. One more quarter of a bad reporting would push them down to a BB plus, which is junk basically, and which will make their life even more difficult because right now they are looking for raising funds to repay their existing debts. Once they become junk, they'll get access to lesser and lesser funds, and that too at a higher rate, making them even more difficult, their life even more difficult. Then what investment bankers did is, they said, okay fine, the debt markets are practically closed for you, so you can either go for an equity issuance, ask your shareholders to put in money, issue rights, ask the existing shareholders to put in money, or we'll try to structure something else. And the something else was in the form of a mandatory convertible note. So basically, it's a debt instrument which is convertible after 5 years into equity, and it's mandatory convertible, which means that the issuers will for sure get written in the form of equity in case the company is not in a position to pay back the debt. So this has a positive implications on the ratings. Even though the company was eventually downgraded, the downgrade was restricted to only one notch. It is now at BB plus. In an alternative scenario, it was expected to go down as low as BB minus because of its debt redemption pressure. The reason is the equity that they have come up with a combined $4 billion issuance, $2 billion equity and $2.1 billion in mandatory convertible notes. Equity improves credit rating because the debt equity ratio, when you issue more equity, is more favorable. Therefore, equity improves the credit rating. And the mandatory convertible notes, even though they are in the form of bonds and debt, since they are convertible, the equity, the ratings agencies have given them a positive treatment. They didn't treat the entire notes as debt, but they treated them as equity. Therefore, they were able to raise about $4 billion without deteriorating their credit rating much. So, I mean, the entire discussion revolves around this point that even a company as huge as ArcelorMittal, or even a country as huge as America or India, they still are in the hands of these rating agencies because they are continuously monitoring them, and if they threaten to downgrade, these companies will come down to their knees. So, in that transaction, actually, Mr. Mittal had to put in $650 million of his own personal money in the rights issuance in order to give confidence to the bond holders. So, ratings, obviously, the higher the rating you have, the easier your life is. The lower rating you have, the difficult your life is as a business. Maybe I just wanted to run you through how a bit more granular, more want to go a bit more detail into how the ratings work out. For example, this is an example ratings methodology, a grid used by mostly Moody's for pharma companies. So on the left side you have 4 or 5 items which are broad ratings factors which Moody's uses to assess the creditworthiness, within which there are sub-factors. For example, the first one is scale, and with the scale they talk about revenue. The second one is business profile. They're talking about diversity of their geography and diversity of their product. And then patents, especially in the case of a pharma company, their revenues are directly linked to their patents, because if they have patented drugs, they'll be able to sell them at a premium as compared to a non-patented drug. So if they have patents expiring next year, and half of their revenues are coming from the drugs which are patented, and if they're expiring next year, then probably the company has little future. So therefore, patents and the pipeline of R&D is also taken into consideration while rating a pharma company. And leverage and coverage is probably common among all the types of all the sectors, because these are the financial metrics. When they say leverage, most ratings agencies use a metric called net debt over EBITDA. Net debt is nothing but the total debt less the cash available on the balance sheet divided by EBITDA is the normal EBITDA computation that we do. And coverage, again, it's a simple ratio. It's EBITDA divided by net interest, which means that how many times the net interest that the company pays on a yearly basis is covered by the current EBITDA. So the higher the leverage, the adverse the impact on ratings, and the higher the coverage, the favorable the impact on the ratings. And if you look at this one, probably only two factors are quantitative. Scale is quantitative because we can measure the revenues of the company, and leverage and coverage are quantitative because we can again measure them from the financial statements. All of this, like business profile, is qualitative. Again, financial policy is qualitative because I can't put a number to the financial policy of a company. And Infosys may have a different financial policy vis-a-vis Reliance because they both belong to two different kinds of industries. And both these companies' management may be having prudent financial policies, but if you ask me to put a number to each of them, then it's extremely difficult. So it's qualitative. Again, the person or the group of people, the analysts sitting in the ratings agency, be it Moody's or Standard & Poor's, they have a discretion at this point, and they exercise a discretion to hopefully diligently and hopefully for the benefit of the investors. So the next couple of slides. Sorry, I've been talking for a long time. Probably any questions or any observations before we
Just going to the previous slide.
Sorry, yes, the previous one.
No, not this. Sorry, the flat rating.
This one.
Now this is. This applies for countries as well as companies.
Yes.
Now, country India has got BBB minus.
Right.
A company has got, let's say, AA plus.
AA plus. Okay.
So, what is the how does the combination work?
Actually,
what impact?
Yeah. India has a BBB minus, and if a company has AA plus, which means that the kind of gilt-edge securities that we talk about are no longer gilt-edge. It's better to invest in the company which has a AA rating than to invest in Government of India securities. It's as simple as that.
No, I'm saying, no, okay, that is,
right.
It's a fair answer. But whether the Indian rating on Indian country, India,
yeah,
has an impact on the rating on the government?
That's a very fantastic question because if a company or a corporation is operating within a particular country, which means that more than 80 to 90% of its operating profits or revenues are coming from one single country, then that company is very much influenced by the political scenario in the country in which it is operating and the economic scenario in which it is operating. For example, there is an Indian company which is selling only to Indian customers and the revenues are coming in rupees, then the political scenario in India and the economic scenario in India is certainly taken into consideration when rating this particular corporation, in which case the company's rating, say, without considering the political and economic situation, is AA, it will be notched down to at least one or two levels depending on the risk that the country has. Therefore, if it's a AA, then it will be notched down to a single A plus or a single A flat. So that has an implication. But for example, if there is a company which has operations in 60 countries and no country, yeah, you want to say something?
Yeah, which means the AA plus which is given to the company,
yeah,
has already taken into account.
Exactly. Exactly. So in the other slide, we spoke about geographic diversity. So if this company is present in 15 countries and each country contributes about 25% or 10% of revenues and operating profits, then the country which is more, the company which is more diversified geographically will have less impact of the country risk. It doesn't matter if the company is incorporated in India or in the United States. Since the company is operating in various geographies, its risk is diversified and its risk is distributed. Whereas if a company is operating only in India and it has no revenues or income from outside India, obviously its country ratings will have an impact on it, and typically a couple of notches are rated down. The rating of the company is downgraded by a couple of notches. So the final rating of that particular company takes into consideration the country risk involved. And this methodology changes from sector to sector. For example, this same methodology can't be used for an oil drilling company or an oil refinery, and an IT company would be having a different kind of methodology. And also, when we talk about the leverage and cash coverage, the benchmark typically for an industrial is about 3 to 3.5x of leverage, which means if the leverage shoots beyond 3.5x, then the rating of that particular company can be downgraded as junk. But this does not hold good. This benchmark limit does not hold good if we talk about a infotech company. Infotech companies and software companies, they have lesser tolerance limits in terms of leverage because they are cash businesses. Most of their businesses are cash, and most of the products and services are exported, and they earn revenues in dollars and euros. Therefore, their tolerance limits to leverage are quite less. In which case, an Infosys or a Wipro, if their leverage goes beyond 1.5x, then probably they might be downgraded. So these tolerance levels also change from sector to sector within the financial factors that we are considering. There is no hard and fast rule as to how much should be the tolerance for each of these industries. It's a consensus of the ratings agencies. For example, Moody's may be setting a benchmark of 3.5x, S&P may be setting a benchmark of 3.4x, but more or less they are in the same ballpark. So, I believe Moody's has about 1,000 or 1,500 ratings methodologies for various sectors, and it keeps publishing new methodologies from time to time. It also revises the methodologies it once issued. For example, a methodology which it used for mining sector 4 years back will be revised after a few years just to accommodate the change in business environment and change in political environment. To pick a recent example for the country risk, recently since Russia invaded Crimea, it's a small country somewhere in Europe. Companies which had exposure to Crimea were severely downgraded. Also, funds, hedge funds and mutual funds which had exposure to Crimea were downgraded. The same thing happened when Greece was in trouble. Greece government was in huge debt, and its rating was downgraded to junk. The rating of Greece is now CCC. So companies which have invested in Greece, or companies which have invested in businesses that have exposure to Greece have been downgraded. So that's where again country risk comes into play. So probably we have about 15 minutes left. I'll quickly, the following slides only give an example as to what are the various benchmarks that the companies use to rate. For example, in the case of a pharma company, size matters. A bigger company will be able to withstand its credit exposure better than a smaller company. Therefore, a company which is more than $60 billion in revenue gets a rating for that particular sub-factor, and it goes as low as C single A in case of 0.5x. So even though a company is highly profitable as compared to another company which is not as profitable, if the company whose profitability is less is large in size, the company with the larger size will be rated higher as compared to the company with a smaller size. The sole reason is, if a company is large enough, it will have access to more channels of sales and more distribution channels as compared to a smaller company. Therefore, it will be able to withstand the changes in business environment better than a smaller company. Therefore, ratings take scale heavily into consideration. Even though the profit and profit margins might be different, scale plays a huge factor. And the subsequent slides only expand in more detail, or explain in more detail what we have seen in the first slide. This slide talks about the business profile, and this ratings agency has particular benchmarks and limits for rating business profile sub-factor. The next one would be financial profile. for example, in this case, if the debt to EBITDA is 0.75x or less than 0.75x, a pharma company can get a AAA rating. But in the case of a mining industry or some other industry, this tolerance level can be much higher or much lower depending on the nature of the business. So basically, we look at all these metrics, we give each individual sub-factor. For example, from this slide, each individual sub-factor will be given an individual rating. For example, scale will be given a rating, business profile will be given a rating, patents will be given a rating. It can be A, B or C, and all these alphabet ratings are converted into a numeric score based on the scale that is given here. So if scale is given a BAA, then a number 9 is assigned to it. If financial policy is given a AAA, then 1 is given to it. And all these individual numeric scores are then weighted according to the percentages given in this slide. For example, if you see scale is given a 25% weight and leverage and cash coverage is given a 24% weight. So the individual scores that we arrived at for the sub-factors are then weighted for these percentages, and then the total aggregate score is determined here. And if the aggregate score falls somewhere around 7.5 to 8.5x, then the rating of that company would be a BAA1. Or if it falls between 10.5 to 11.5, then it comes around BA1. So it's semi-mathematical. Part of it is mathematical because numbers are assigned. Part of it is qualitative because financial policy, what rating should be given is left to the analyst at the Standard & Poor's or Moody's ratings agency. So that can't be precisely computed. So an example company with a sub-factor score, the last but one column of 6 for scale, 9 for business profile, and 6 for financial policy will have a weighted factor score of 7.2, and as per this rating scale or this rating scale, it falls in the bucket of A3. So that's how an indicative rating is arrived at. Well, this is fairly indicative rating because all the information is taken from publicly available sources. But in reality, when companies want ratings agencies to rate their debt, they actually give access to a lot more information which is not public as well. And the ratings agencies look at these non-public information, and then they come upon they make a judgment as to how much the rating should be. I think I've just put a slide here, probably to test our own knowledge or test our own understanding. So we have various symbols here. On the left side we have the United States flag, on the right side we have Indian flag, and on the left side we have Microsoft, GE, Walmart, and there is an Apple there. And on the right side we have Reliance, State Bank, and Tata. Why not try and guess what the ratings of these various entities could be? Just a guess, just for fun. Probably India we already know, we already discussed many times. It is, what? India is just about junk, so it's BBB minus, we know that. And US also we discussed, US is rated AAA by Moody's, but it was downgraded by Standard & Poor's to single A plus. Therefore, we know these two. What could be Microsoft's rating? As you said, is Microsoft rated better than United States or lower than United States? That's something interesting to guess probably. Better or worse than United States? Okay, that's a great answer. Apple? Apple is rated better, okay. Apple actually issued $17 billion of debt in 2012 or in January 2013 as a part of the transaction. That was their first debt. They had $100 billion in cash, but they still raised $17 billion in debt because they sell iPhones and iPads in 100 different countries, in China, India, Indonesia, and their money is stuck in these various countries. Repatriating their money has tax implications. For example, India has something called a withholding tax. If a company wants to take back its money, probably the government might deduct some percentage as tax. Therefore, what it did is, let the money stay there, we'll use it in those respective countries. We need money in the United States, so raise some debt in the United States even though we don't need it. So they raised $17 billion and it was the largest debt transaction at that time. So for that reason they needed to get rated. They were rated, we'll see what they were rated. General Electric, it's about a 150-year-old company. What is it rated better than the United States or at par with the United States or worse than the United States? Okay, at par probably. And Walmart is a retailer. It carries different kinds of risk as compared to General Electric and Microsoft. Walmart is not a cash business because they do have to lend their customers. They have to give credit to their customers in order to sustain their revenues. So ideally, Walmart should not be rated the same as Microsoft and GE or United States. And Walmart is a retail company and therefore they have to invest in lots of stores. Their capital expenditures is much higher as compared to Microsoft. All Microsoft does is hire some programmers and come up with Windows and some other doors and they sell it in the market. So Walmart has a different risk profile. Let's come to India. India's credit rating is BBB minus that we know, we have discussed many times. What would Reliance's be? Will it be better than India or will it be worse than India? It's better than India. Okay, that's probably a good guess. Let's see. What about Tata Motors? Tata is probably much older than Reliance. It's been in the existing for more than 100 years, I believe. So, is it better rated or worse rated as compared to India? Okay, better. State Bank? Better rated. Okay, let's see. I've jotted down the answers in the next slide. So those are the answers. As I said, Microsoft is rated at par with or better than United States. You are correct. But Apple is not. GE is not. Walmart is not. Reliance is rated better than the Indian government. One notch above or two notches above Indian government. State Bank is rated at par with Indian government because State Bank is a government entity and the Indian government holds a huge majority in State Bank of India. So its credit can't be better than Indian government. Tata Motors. I mean, why is Tata Motors rated so low? The reason being, automotive business, all automotive, I mean, if I compare all the automotive manufacturers, then Tata ranks top. Ford or Fiat has a single B. Or Ford at some point of time was triple C. For such a huge company, at some point of time, a few years back, was a triple C, a junk one. The reason is, all these automotive companies have to invest heavily in plants. We have seen what happened to Ratan Tata when he wanted to start the nano plant in West Bengal. So they incur huge costs, huge startup costs, and then the gestation period is so huge. Once they start a plant, for the first car to be sold in the market, it takes 4 to 5 years. And then the demand at the point of sale might be different from the demand which was estimated at the point of the commencement of the plant. And also, just like Walmart, all these auto companies have their own financing arms. For example, Bajaj may be selling scooters and bikes, but Bajaj also has an automotive financing division. They have to lend their customers money so that they can buy goods from them. So, the kind of risks involved in automotive businesses, and also this is totally a volatile business. Sometimes in a particular year the car sales might go up and in a particular year the car sales might come down depending on the disposable incomes available to the people of their country. Therefore, given the risk profile of that particular industry, all automotive manufacturers or most automotive manufacturers are rated pretty low. And for them to raise debt in the market, they have to pay a huge interest rate. So I think that's probably we can stop it here. Hopefully my session is helpful to you, is informative to you. And I've learned as much as I intended to impart. So I thank the Bangalore branch for giving me this opportunity, and I thank for your patience for listening through my monologues.
One more question.
Yes.
If you don't mind. Can you go to that rating?
The rating? Sorry?
Yeah. Right. Yes.
Yeah.
Now, in the case of Ranbaxy, there was an incident of FDA had some observations on these products.
Oh, which company?
Ranbaxy.
Ranbaxy, right.
Where does it fit in that type of incidents? At risk of the product being rejected or going to be...
Yes, so that's a rare scenario. I mean, if there are 100 pharma companies, there are 100 software companies, there is one Satyam. So that eventuality is still at the discretion of the analyst of the ratings agency. For example, this is only a guideline. I might use this grade to come up with an indicative ratings agency which says that if Moody's or S&P rates this particular company, then they might probably give, say, this kind of rating. So this is for the users like us to, as a guideline to understand how ratings agencies rate the companies. Whereas ratings agencies, they don't need to stick to this scale. This is only an indicative scale. But in the case of Ranbaxy, where the issue is so glaring, obviously that will be taken into consideration. And when they issue the rating and come up with a report, they mention it in a separate section. Any extraordinary item is mentioned in a separate section where they explain the reasons why they treated it that particular way. And it will definitely be taken into consideration. It will impact their ratings. Yes, sir.
That's about bond yields and interest rate movement.
Okay. I actually intended to cover bond markets not in depth, but only as an introduction. But since you asked it, when you look at basically every bond, especially corporate bonds, yields are quoted as a percentage basis points over the benchmark rate. In the case of US bonds, the benchmark rate is the treasury rate, the Fed government's treasury rate. For example, if say Apple wants to issue a 10-year bond and it was able to issue at say 3%, and the benchmark treasury rate is say 2%, then 100 basis points is the spread Apple is able to raise the money at. And this spread varies on a day-to-day basis as the bonds are traded every day in the bond market. For example, if there is a lot of liquidity in the market and if Apple's financials and business profile remain the same, then it might actually tighten. For example, the yield of a 10-year Apple bond might tighten. It was issued at 100 basis points over the treasury, but it might actually come down to 98 or 95. But if Apple's risk profile increases or the country in which Apple operates, the risk profile changes, then Apple spreads might go up to 102 or 103. So these spreads are actually influenced by multiple factors. It can be factors concerning the company or the business of the company, or it can be external factors like, for example, suddenly we realize that 50% of Apple's revenues are coming from Crimea or Iraq. Now that Iraq is facing political trouble, Apple's credit spreads will widen quite a lot. So widening is worsening, and widening is bad for the company. Tightening is good for the company. And just to touch upon the spread yield relationship, spread. If the yield goes up, the spread goes up. If at 4% the spread is 100 bips, then at 5% the spread is 200 bips. So it's a direct relationship there, and probably we'll have another session on spread and yields. It's actually interesting for me also to touch upon those aspects and discuss those, because for 4 years with Deutsche Bank, that's what I did on a day-to-day basis in Mumbai and in London. But let's probably have it for a separate session because it will be too technical, and probably the slides that I have won't be able to substantiate the kind of discussion that we are having here. But thanks a lot. Thanks for sitting through a 2-hour session, and thanks for the participation. And I thank the branch and the management for giving me this opportunity. It's wonderful talking to you all.
Dear professional friends, on behalf of Bangalore branch of SIRC of ICI and all of us present here, I sincerely thank Mr. Lakshmi Prasad for sparing his valuable time with us and sharing his knowledge on the topic. I now request C.A. Parmeshwar to come forward and present a memento for our speaker as a token of appreciation and gratitude.